What trends are you riding? That's the question we ask ourselves every day, but specifically on this Thursday where we talk about trading the trend. My name is James Boyd, got Connie Hill in the chat. Some of you mentioned redheads rule when Connie and I are combined on a session. Sure, why not? I'm not going to argue that. Now, we'd like to welcome Will with us, Trader Joe, Dom, BJ, Grace H, Riceberg, Lisa Jack, Cecil, and many others. Now, just real quick as we get started, Connie and myself, we do post educational content on X. You're going to see that if we go to that page of Connie's, I'll post that in the chat, so you can just click on that and follow Connie. You're going to also see that, for example, if you go to this page right here, I'll put these links right at the top, so that way you can bookmark those. Those are the links. You'll notice it's our first name, last name, CS for Charles Schwab. Always a reminder, we don't solicit anyone, so if someone reaches out to you, it's not us, okay? And also a quick reminder that these sessions are broadcast via YouTube, our channel called Trader Talks Schwab Coaching Webcast. These are live and recorded. Speaking of live, let's go ahead and actually hit the disclosures real quick. Remember that when we talk about examples, we will do stock and option examples. When we talk about options, not all options are the same. And also remember that options are not suitable for all investors. When we talk about the examples, I'm going to give general information, and that is not considered an individualized recommendation. You get to decide what you want to invest and if you want to invest. Also, when we talk about examples, we will do those in the Paper Money software application. Investing involves risk, including loss of principal. Got to take a risk to actually see if we can't get a potential return. Be aware of what that risk is, and also maybe some key components that might drive that risk and potentially rewards. Understand when we talk about, let's say, when we bring up examples of futures, we're not trading futures. We're looking at the futures prices, which then might relate to indexes and sectors and so on. We'll show those here a little bit today. And so we're going to bring up things like oil and gas and so on. So we're not, again, not trading. Ben Watson teaches that, but we will bring some of those up to kind of show what are some of the trends we're seeing in the market, up or down. Now, when we talk about our examples, we'll use technical analysis to identify those existing and maybe future potential trends. We'll talk about those trends in different time frames. And we're going to look at some past and some new examples. So first off, if you listened last night to that, release of information, I'm going to call it, if you watched oil during that last night one-way speech, oil didn't really dig what was said, right? Still some unknowns. Now, when we look at oil, different types of oil, right? Light, sweet crude, CL, push to the upside. Now, I want to watch the difference. We'll look at the difference between light, sweet crude and Brent oil. But actually, if we close here, this would be the highest close that we've had. Okay? Now, want to talk about how that relates to the energy. Want to talk about how that relates to energy sector in general. Want to talk about how that relates really also to energy stocks. Like, what are we seeing there? Now, if we actually saw Brent oil, okay, we actually see that BZ, that's not hitting a brand new high, but it is over the $100 threshold so far. Now, the reason why, now, by the way, if we brought up gas, okay, is gas actually hitting a brand new high? No, it's not, but it is kind of building like a higher base of support. Okay, we've talked about that. This is a big theme in the stock market, all right? When we talk about stock markets, we're talking about many sectors that are very sensitive to what that price of oil is, like industrials, like transports, like discretionaries, and so on. Now, when we bring up, let's say, the VIX just real quick, we're not seeing a brand new high on that. Hallelujah. Okay. We actually look at the US dollar. How did that fare? It didn't actually, went down yesterday, bounced back today off of some, let's say, those comments. And you're going to see if we look at the last one, the TNX CGI, the 10-year, where are we at there? Same thing, kind of pushed to the upside a little bit, but paring back some of the movement here. Now, when we talk about this, we're going to bring up let's say the SPX and kind of say, what do we got on the equity markets? Now, remember, investing is not just stocks. When we look at stocks, we're talking about the S&P 500. other things like commodities, fixed income, currencies, so on, can influence what the stock market does. That's why we look at those previous symbols. Now, if we look at the SPX, today when we open it up lower, you can kind of imagine there's some people thinking, oh no, it's going to be horrible. However, the price actually did fall right down to the upward trending 10-period moving average. So far, if we close here, we're closing higher than when we opened, closing higher than where we closed. Well, slightly lower than where we closed yesterday. And I mean slightly. That's if we closed here. So the fact that we're able to hold the moving average cross so far, the fact that we're getting intraday bounce, better. When you actually look at the SPX EW, the equal weighted, now a lot of times when markets go up, people will say comments like, yeah, it's just tech, yeah, it's just discretionary. You want to kind of see, are we starting to get kind of more participation from more sectors? Well, starting to get a turn, use things like utilities, communication services, technology, things like that, getting a better turn here, okay? And if we look at, let's say, the NASDAQ, what about the NASDAQ and the SOX? NASDAQ even getting above its moving averages. Same thing actually on the NASDAQ, holding actually that intraday low. SOX, which got really pushed down 3 days ago, holding a little bit better. Remember, if you're going to get the market to go up, you typically got to get NASDAQ to hold or go up. You also need the financials to go up and hold, which I'll show you in just a sec. Last but not least, if we look at Dow Jones, are we seeing a little turn? Same thing on the chart. Has it broken the horizontal resistance? No. Where are those other bulls going to probably start to come in? If we can start to get above that 465, 467, we might hear the words charge by the bulls, okay? Now, a lot of bulls are saying, yeah, I saw the moving average crossover. I don't believe it. I want to see a little bit more. Again, I think that market, 467, that's going to be the critical juncture here. The fact that the equity markets are able to hold, considering the light sweet crude went up $10 or 10%, I mean, if that would have happened a week ago, we'd be probably down 1,000. So just kind of remember that, okay? Last one, if you like smaller caps, getting a little actually turn here. It looks just like the large caps. And if you like to look at, let's say, I'm actually thinking about the EMD. There you go, mid caps. So we got large, the Dow Jones. If we look at, let's say, mid caps, really the large caps, the Dow, small caps, the Russell, mid caps, they all kind of look like they're kind of trying to break that horizontal. And again, if we start closing above that horizontal, some of that pent-up buying frustration. James, I have money in my pocket and it's burning a hole. I got more money than ideas right now. Okay. That could be actually a good thing. Okay. For some investors, they might say, hey, finally got a pullback. And now I'm going to try to actually trade some of these upswings if we can get them. Now, the one thing I want to see is, are there any questions from you? Yeah, so the comment was from BJ, short-term MACD divergence, okay? If we go back to, let's say, aren't we down 3,000? I'm not sure what are you talking about the Dow down 3,000? Okay, is that what you're talking about? Let's say we were at 50,000 on the Dow or 505, and how far are we down on, let's say, the Dow Jones? And I'm going to take from the very high to where we are now. The answer is we're down 7.7% from the high. Now, I don't know if that's a bad thing. Like, if we're talking, like, again, we always talk about it. If we're in a position where we have positions and the market pulls back, yeah, sure, market pulls back and it drags the portfolio down. Sure, we get it. Now, if we're talking about we're trying to get in some names, slamming to the upside. Now, if I said, hey, what do you think the energy sector is doing with crude oil going up, let's say, $10 more per barrel? What do you think energy would be doing? Well, this is where it gets a little shocking, folks, okay? Make sure you're sitting down in your chair and you got your popcorn in your lap. Here's the energy sector. Can anyone explain to me how is oil up $10 and the energy sector is like barely up for the day? and even had an intraday rally up to the 10-period moving average, which is pointed down, people use the opportunity to sell into the strength. Can anyone actually tell me what's happening? Anyone? Well, this is your classic kind of sell into strength. It's not what happened in the past, it's where they think it's going to go in the future. Now, I don't know if you've picked up some sentiment on some things that I've said. Not saying what I've said is going to happen. But if some people actually think that, hey, some of that movement in oil is going to maybe come down some, well, maybe they might say, look, I don't want to buy more of the energy stocks. Those have been going up. It's about where do you think they're going to go? Well, now, again, we're not saying it can't pull back some, but maybe could energy maybe fall down to 1,200? Could it fall down to, let's say, 1,150? That's not saying it didn't keep some of the upward trend, but there are some people that take profit. Ka-ching, 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 they take profit. Okay, now, my play is not on the energy space, but if we take a look at, let's say, and I'm talking about the sector, if we actually said, well, what's Chevron doing? Chevron's kind of looking like that energy sector. Of course it is. It's a big chunk of it. And so is that XOM. Of course it is. It's a big chunk of the energy sector. We get it. Now, if I went back to one name, ConocoPhillips, another big horse, and I might look at that. That's another one that kind of is right up near that moving average crossover from a negative sense. And the fourth one I want to bring up is FANG. And if you look at, let's say, FANG, here she is. Now, this is what's called counter trend trading. If you actually think that that price might pull back a little bit, that some investors that are sitting flush with some gains, what might cause some of those investors to get out? It's almost like we're at the bottom of a thinner tree trunk and we're shaking the tree. Well, if all of a sudden, if those people are up in the tree holding on to the tree limb or the trunk, etc., if all of a sudden we start coming down, just like we did on the equity markets, we come down to here, we get below that. We come down to here, we get below that. We come down to here, get below that. Come down to here, get below that. All of a sudden, these lines represent where some people might set their stops, but the lower that it goes, the more pain that it creates. And some of those investors decide, look, I don't want to be in anymore. And they just tap out. What do you mean tap out? They probably get out of some of their position and or all of it. Now, we saw that in the stock market recently, right? The lower it goes, the more people that might want to get out. They might get out of the whole position or some of it. And the volatility shoots to the upside as people start to say uncle or mama, right? That's what happens, right? Now, I'm not saying that's going to exactly work out, let's say in oil, but some investors might say, James, I think some of these things might be a little high. And the forecast where the oil prices are going to be in the next 3 months, 6 months, 9 months, 12 months, they're maybe a little overblown. Okay. Now, I'm going to use FANG as one example of trying to take a bearish trade on a stock that has been going up. That's a key word. It has been going up. Now, what I'm going to do on this is we're going to say, look, we're going to buy, okay, go to the trade tab, going to go to FANG, okay? But why do I feel like I'm going to be on some YouTube short video with what I just said? This is kind of bad feeling right now. Now, here it is. So now I'm going to look at the difference between FANG as far as liquidity or ConocoPhillips, okay? Now, when I look at FANG and I go look at, let's say, the volume, that's not going to tell me much of, I mean, it's going to tell me something about as far as liquidity. I'd like to see that over 1 million, okay? But if we look at, let's say, the option bid-ask spread, and I'm going to look at the calls and the puts, you got 50 cents over here, 50 cents on the 190, 195. I'm just looking at the first strike in the money, first strike out of the money, 50 cents on the calls. Over here, 50 cents, right here, 40 cents. All right, now, yeah, so yesterday I was taking my granddaughter home with my wife, and I was singing bingo, B-I-N-G-O-B. So anyway, I can have a little fun, but I'm going to hold it off. She really enjoyed it, okay? But I'm going to kind of No more uncle, mama. Okay. So just kind of straight stocks here. Now, we take a look at this. I'm going to look at ConocoPhillips and kind of see which one's a little narrower. Is there one? That's 15 cents there, right? That's 60 cents. Okay. Now, if someone said, look, James, I was kind of thinking about maybe this one over here on the call side, 35 cents, that one right there, 15 cents. I don't know about you, but ConocoPhillips looks a little bit more liquid, a little bit. Okay. Now, if we actually thought the price of, let's say, oil was going to drop some, just some, okay, that some investors might maybe take some of their gains a little bit, what I'm going to do is I'm going to choose like slightly out of the money long put vertical. VING. Anyway, you should see her face. My gosh, she's so cute. My gosh. I tell you what, that granddaughter can't do anything wrong. Now, here's the deal. Okay, 125, we're buying the 125 put. Now, if you buy the 125 put, okay, what is that doing? Well, you actually think the price is going to go down below that strike and or maybe even get lower. But I don't want to buy the puts because you got to pay for them. I know. That's what the 120 put is for. The 120 put is you're selling that, you're getting a credit, and when you get a credit, it lowers the overall debit on the long put vertical trade. I tell you what, if there's anything I'm going to do on this green earth, okay, I'm going to help you really understand puts and why the investor might use puts to protect their position and or their portfolio. Reading a book on them, the online course about them, etc., is not sufficient. Because until you actually do them in the paper money account a couple hundred times, you don't really understand how the puts can be helpful to manage risk. Most people talk about profits. I'm trying to get this profit, trying to get this profit. You can't track profits because it's all forecasted. But you better dang believe you can track risk. And the best investors I know track risk on a daily basis, and they try to actually make profits, but they're tracking the risk. Okay. Now, speaking of risk, what is the risk? Well, it's what you actually buy it for, 168. Confirm and send. Now, what we actually see in this case, in the IRA account, the debit, 168. Okay. That debit is the max loss. It's 168. Now, why is the profit so big? Why is the profit so, well, it's slightly out of the money. Okay. So this is not your uncle's 1-for-1 reward risk ratio here. This is really the max profit, 332, max loss, 168, bigger profit because you're going one strike out of the money and it's tilting the profit higher. And remember, whenever you go out of the money on the put side, you need that stock to move to really for it to become more profitable. What's the break-even expiration for the May expiration? The 15th of May. Answer, 123.32. Where are we at now? 129. So if you go out of the money, whether it's calls or you go out of the money on puts, you need the stock to move. If you're a buyer, okay, of a long call, buyer of a long put. Now, example number one, let's just do this example, okay? How much are we paying for the commission? Okay, $1.30. If I come in here and go right there, that is going to be a bearish trade on ConocoPhillips, thinking that someday in the near future, oil might come down a little bit. Do not take this that I don't think there's going to be maybe some built-in underlying pressure. I get that, okay? But, you know, thinking that economies can actually hold a 110 price level on light sweet crude oil without going into recession, which also could actually maybe try to bring down the pressure, it's probably pretty unlikely. So we're kind of trading the unlikely scenario here, okay? Now, anyway, I get what you're saying. Yeah, she was sitting on my lap yesterday, up in my upstairs office, and I teach her stuff, so why not? Now, any questions from you? So trade number one was a long put vertical on ConocoPhillips. Now, remember, how did you come to the idea of that? Well, I just thought it was weird that you have oil going up actually 10, energy, you see profit-taking behavior. Why did you say that? How can you see that? Well, you got profit-taking behavior when you have the price of oil that rallies, and then you see a large upper shadow. That large upper shadow connecting or hitting the downward trending 10-period moving average. And so instead of that being a big fat green candle the size of the Eiffel Tower, people sold into it. That's called profit taking. Okay. Now, any other questions? Yeah, no, I got a couple shows that she likes. Okay, we talk about those. Yeah, it is fun. Yeah, I got 2 grandkids, maybe a third one early next year, but I have not been told. But I think that's going to happen because I have a forecast. Okay. Yeah, you can sing FANG F. No, we did ConocoPhillips, but I know what you mean. That's funny. Okay, now any other questions? Now, why did you actually choose a long put vertical? Answer: we want a bigger max gain. If we actually think that move could happen, more probable to happen, probably going to pick a long put vertical over a short call vertical. The what do you give away? It's less probable. Okay. But if you actually think, look, I think I could be right, which sometimes you feel like that, you pick a strategy that has a higher potential upside. All right. Now, any other questions? Well, we'll find out. Now, I want to also go back to just real quick. Speaking of actually oil, we talked about, I just want to take a look at, let's say, airlines real quick. I mean, you got to imagine when oil goes up like it did, airlines would have got crushed. Delta kind of being viewed, well, I mean, it went down 84 cents for the day. I'm not sure if it's backbreaking, okay? But you always like green candles up for the day from the previous day, but down some. UAL, that was the one that got kind of pushed around. That one was down about 5% or 6%, but who was counting? But that kind of looks like it's trying to bounce back. Now, it's interesting that you see a little bounce back. How do you see the bounce back? What's the green candle? We're closing higher than where we opened. If we closed here, we're still down for the day, but the support did not break. Did it drop? Yeah, it did. That's why we're pulling it up. Now, the third chart that we actually pulled up, let's say from yesterday, was Intel. Okay. Now, yesterday we talked about kind of, hey, we noticed that Intel was looking a little, let's go back to where we were yesterday. Okay. And if we look at where we were yesterday, we talked about the lines, the moving average envelope lines. You could think of this almost like standard deviation. But these lines, remember, the blue line is just our 10-period moving average, exponential moving average. The yellow line is 3% above that 10-period moving average. Red, 5% above the 10-period moving average. And the white line, we actually said, is 7% above the 10-period moving average. More of the story is, look, the higher you buy, I mean, if you're buying at the red line or higher, or at the white line and or higher, you're buying into the potential nosebleeds of price action. What does that even mean? Nosebleeds. You're way up there. Okay. So if you buy there, I mean, it's not a highly likely scenario. Now, this is the candle from yesterday. Now, remember, if we're at the red line or we're at the white line, the highest likelihood is you get a short-term pullback, even intraday. Now, if we don't know what's going to happen tomorrow, which we didn't, it wouldn't be unthinkable that we maybe come down to the midsection of this large, big candle. That's called support level number 1. Why are we bringing it up? Well, because we're going to try to hit it again. Now, if we kind of said what would be the support level number 2? Well, it's the open of the green candle. So this is just called S1, support 1, S for support. Support 2 or S2 is actually right at the open prices. That might be the markers where someone says, look, if I can get a pullback, I'm going to try to get into those areas. Now, you always got to go back to the whole idea of theme, of trend, which is if you make a high, the highest likelihood is a higher low. Okay, so if you make a high, the highest likelihood is a higher low. You make a high, you've got some momentum. You make a high, you make a higher low, you got a high with a higher low, you got a momentum, and you could start to get trend. You do the opposite of that, you have not bullish momentum like we just said, we have bearish momentum. Now, if we go forward in time, well, what do we got? Well, we come down right to this S1 level, okay? Now, again, support level, it's just an area. Now, what happens? How much lower did it go? Well, it went down about another 60 cents from where that support level was. Well, maybe, James, the line you drew wasn't very good. Not fair, but I just drew it manually. And that's probably true. My line probably could have been a little bit lower to signify the middle of that. Who cares? If we look at this, someone was buying on that midsection. Did anybody else see that? Was anybody else waiting for it to come on down? Okay. Now, I'm telling you, a lot of times when you see the prices drop like that after making a new high, that's typically not bearish. That could be the potential opportunity. Now, when the stock has rallied like this, if we're talking about stock buying, we'd have to go back to exactly what we just said again, which is where are we at now? We're above the red line. We're above the white line. If we're talking about stock buying, I'm not going to buy the stock. Hit there. Okay. But if we went back and said, well, let's do it again and say, well, what's the middle of that green candle? Large one, 47 to 83. What's the open price of that green candle? 47.83 is the S1. That's where some people might try to buy an intraday price movement. 46.06 is where some people might say, geez, if I really got it to drop, 46.06, which is today's open price. Now, who might do some type of trades when the price is up that high? Why? Who does that? Well, they're probably going to pick strategies that are not as sensitive to price movement. Now, speaking of that, we know that strategies that are not as sensitive to price movement as like stocks, we got things like cash secured puts, short put verticals, long call verticals, among other things. But the things we talk about are those three main strategies if we're talking about bullish strategies. Now, the one thing that we have in this market is volatility, okay? Volatility. And that, if we go back to the trade tab, we say, what type of volatility do we have here on Intel? 76. Hello. Okay. Now, if we go down to, let's say, today's option statistics, and we actually kind of just, let's circle this for just a sec. What's the high? Well, about 95%. Well, what's the low over the last 52 weeks? 43. Where are we at now in that range on a percentile range? You're at the 56th percentile, which that's crazy. You're at the 56th percentile. And if we're talking about options that are 40 days expiration, we're at the 71st. I mean, you can kind of see it's a little high, but that's pretty crazy that you would think it's even higher than that. Okay. Now, what I'm going to do on this is, since it's high again, now we're not saying that now remember, tomorrow the market's closed. It's Good Friday, literally a Good Friday. Okay. But Monday, could we see an intraday dip again? We could. We've talked about those lines. Keep an eye on those. Set an alert. Some people might do buy limit orders and so on. But wonder if they want to get in today. Well, I'm not doing a stock position. I'm going to go back to the cash secured put idea. Now, what's interesting about what about volatility is the higher the volatility, the bigger the premiums. And we get that. We could see that premium expressed in ROR. Okay. The ROR is like a dividend yield. But here, instead of looking at dividends, we're looking at the option premium divided by the stock price. The higher the percentage, the richer it is. Higher premium doesn't mean better. It means there's more risk, honey. Okay. Now, that means up and down, but we're thinking down. Okay. Now, if you take a look at this, I'm going to come down to the lower range of delta. So we always talk about delta 30 to 40. That's out of the money. That means the strikes are below the current stock price. But I wonder if I said I was just being a little chicken. Okay. And I'm a little nervous. Now, that's usually the way I am. Okay. Don't make fun of me. There's other people that are the complete opposite of that. Now, if I click on that 280, you're now going to notice that we're just doing a strategy where we're trying to sell the put, the 46, and we're saying, look, can I maybe get something the mid 284? That 284 is right here. Okay, right here. And if we take a look at that, we're saying, look, I'll agree to buy those shares from now to expiration, but you got to give me some money, honey. And that money is not made. That money is put into your cash balance. as you're holding on the position, this position doesn't cease to trade, and that's what's making the profit and loss over time. That stock is, the option price is being affected by stock price movement, time decay, and the volatility. Now, what we're going to do in this case is we're going to sell the 46. Now, I'm going to go back to that IRA account. I'm going to bring up that position, Intel. And what we're going to do is we're going to say, hey, look, I'm going to actually buy a put below that. That way the risk is not all the way down to zero. The other one is so we don't have to tie up as much capital. If an investor does not do this and they sell a lot of puts, it will not take a lot of cash secured puts to make it where you don't have any more buying power. Okay. Now, what we're going to do is we're going to sell the 46. Tell me which one I should do. Now, here's the thing. You could tell me what I should do. I can't tell you what to do, but you can tell me what to do. Now, if we go to sell vertical, tell me which put to buy. Why would you buy it? Well, in our example, we talk about buying a put with a delta of blank or less. What's the fill in the blank? Well, fill in the blank is we talk about buying a delta of 10 or less. Now, that's just being out of the money, below the strike. Now, remember, do we have to go a delta of 10 or less? No. But in our case, we're going to. Do we have to do the 37? No. Could we do the 36? Yes. Why would you do the 36 over the 37? Tighter bid-ask spread. Okay. Well, could you do the 35? You could do the 35. Check the liquidity. It's wider. Probably going to hold right around that 36. Bid-ask spread, 5 cents. Open interest, 4,000 contracts. So I'm going to come down to the 36. So if you have a 46 strike and a 36 strike, okay, here we go, $10 wide. So this is like a $10 wide vertical where you have a credit of 225. So by buying a slightly more out of the money put, it actually increases the credit just a smidge. Now we actually see it when we take a look at this. This is really like your cash secured put. It's really a short, it's a cash secured put with downside protection. A deep out of the money put with a delta of 10 or less. So you can think of this as a cash secured put, but there is downside protection, and that's why it's being labeled as a vertical. Now, the comment from Dagan is, JB, why do you not go delta neutral? Because I'm trying to, so Dagan actually says, I'm trying to understand this. So what is delta neutral? Delta neutral is like cash to some degree. If the paper money account goes to cash and the markets go up and down, that's delta neutral. Okay. Now, is there reasons to go to cash? Yeah, sure. Okay. Why do some people like to pick a direction of some sort? Because that investor feels like they're decent at it or pretty good. Now, if you pick a vertical, it's not like Dagan that you're actually forecasting a stock-like movement. Here, we're just saying, look, I just need the stock. I'm even going to assume that we're wrong a little bit. The stock price is at $49.62. Here's the break even, $43.75. So this is investors saying, look, I could be wrong, but I have $6 of margin, okay, buffer, if you will, that if that stock goes from $49.63 down to $43.75, it could go down $6. I can still have a little buffer, okay? So why do some people, why do they not go delta neutral and do things like iron condors or something that is like cash, etc.? Well, because we're trying to investigate a rate of return. Why don't I go more cash? Why don't I do things like more cash-like products? Well, that, number one, that's not what the class is. Number two, we could teach things like in that realm, but the paper money doesn't really allow for the practice of that. That's the other thing. Okay. Now, James, are you against those things? Oh, absolutely not. Okay. But I would say in our realm of what we do, If the investor decided that they were just going to go more to, let's say, cash, that is another form of delta neutral because you're not influenced by what the market does. Okay. Now, if we take a look at that, notice the credit, less the commission, send the order. And that's sitting there. Yeah. So now here's the thing. Protection in this market is needed. Look, I'm going to die on the hill helping you understand puts. Okay. Whether you're buying them or selling them, you're really right. Now let's go. Speaking of that, now who said that? Okay. It was Steve. Of course it is. It's always some sharp person named Steve. Okay. Now, what I want to do is let's imagine that you said, James, I would like to. Now, I'm not going to do this one in this example, but I want to go back to something just real quick to the Netflix example. Okay. Now, let's imagine the investor said, and we're going to use Netflix as the example, and I'm just going to do this fast. Let's say the investor said, look, I want to buy Netflix, but I want to protect my downside. Okay. As we all age, I know. Okay. Wrinkles can match some of the clothing that we wear. It's not all bad. Okay. Wrinkles might mean that you're wiser. Okay. You've had experience. You're aged, which doesn't necessarily mean bad. You're more mature. These are all good things. Okay. Now I want to imagine the investor says, look, I want to get it on Netflix, but I'm really kind of I want to be watching the downside. I want to have some upside potential, but I definitely want to have a defined risk. Now, again, in this current market, the investor might say, I'm going to probably collar a couple stocks. Think of this as a stock position where they're just naturally bullish already, but they just want to taper down the sensitivity to price fluctuation, but also that affects their emotions. Okay. Now, what I'm going to do just real quick, and I'm not sure if I have even enough capital to take this all the way through, but I would like Steve to practice this in the paper money account. If you want to be kind of like you're thinking, well, don't this not include me? I want to jump in on this in the paper money account too. Well, let's practice together in the paper money account. Okay. So number one, if the investor thinks the stock's going to go up, they might consider a stock position. In this case, it's a $98 stock. We buy the shares of the stock. Okay, there. Now, number two, we're going to go out to the options that have more than 20 days to expiration. We tend to focus on the monthly options where there tends to be more liquidity. Now, if we decided in this case that, hey, I want to, in this case, sell a call option where there is some upside potential. Now, normally we like to go delta 30 to 40, but I'm looking at the table that we have, and I'm, okay, fine. We'll look at the 103. The 103 is really having a bid-ask spread of a nickel. We haven't seen that in a while, okay? Now, number one is we got the stock down here. How do we get that? Click on the ask price. Number two, go down to first triggers SEQ, right there. Click. Now, the second thing in this case, if you look at this, we're going to sell the 103. Now, if we notice this, that's selling a call. If you sell the call, you have the shares. That's your classic cover call. Problem with the cover call is that's not downside protection. The cover call, the premium, that's an income strategy. Guys and gals, a lot of times we create our own emotional volatility by the strategy that you pick, by the stocks that you select a lot of times. Now, we know the market's been more volatile. We get it, okay? So the investor might decide to alter strategy. They might consider that. We're going to come over here to the put side, delta 30-40. We're going to buy the 34. Why? Why is the investor buying that 94? Well, because they want to have a defined risk. Now, the comment that was brought up to me was, hey, well, when you do this type of trade, why don't you maybe just buy less shares? La la. Oh my gosh. Someone's listening. I'm joking. I know you're listening. Now, that's kind of like what we've been saying. Dollar cost averaging. Okay. Now, if you take a look at this position, you're now going to see, and I can't bring it up there. If we have the shares, and let me take those off. There's the shares, there's your short call, and there's the long put. Okay. So could you, if you said I don't trade options, but I want to trade the upside price movement, could you, for example, just buy shares? Well, you could, which is kind of getting to the point of this, but buying the shares of the stock does not define the risk. Okay. Now, this is not defined risk indefinitely. This is defined risk for the 15th of May. So someone says, why don't I just buy less shares and replicate the delta versus why would I do a collar? Well, the collar is getting the same delta as, let's say, buying shares, but this caps this actually creates a floor of loss on the on the position. Now, how is buying the shares of stock different than the collar for the downside? We just said that. But how is buying less shares different than, let's say, doing a collar? Well, you're going to see the opposite side of this is if you own the shares, less number of shares, trying to mimic the collar delta, you do not have a capped upside. That's the difference. Now, when I've talked about ad nauseum, I mean, when I know I've said it a couple times, I know you know I've heard 10 times, maybe not, okay? But the big actually thing is, in a more volatile market, dollar cost averaging, building a position. For many investors, it makes sense because in volatility, you're probably going to have second, third, fourth shots to maybe try to get in as the prices swing. The saddest thing about when the market pulls back, you don't tend to have any money because A, you didn't sell anything when the market fell, and then two, we're so impatient to try to put all of our positions on at one time. Okay. Now, you could actually see the max gain, which is about $500. You could also see the max loss, which is right south of it's about 428. So it has more of like a long call vertical like max gain, max loss scenario. Now, remember, is just because you sold the call to the upside, if you see that stock breaking to the upside, could you try to buy the call back? Yes. Could it be at a higher price? Yes. But here, I'm not even going to touch it. Our goal on this is we're going to go over earnings and see if we can't get a little pop to the upside. But what are we really trying to trade? We're trying to get a certain percentage of that maximum gain. The rule of thumb we talk about is, could we get 50% in the first 10 trading days? The investor might take it or roll the position. 65% with more than 20 days remaining, they might take it or roll the position. Third, or just take it entirely. The third is 80% of the max gain ever, irregardless of how many days are remaining. Okay. Now, what we're going to do in this case is we're going to go ahead and actually send that order. Okay. Target, excuse me. Short call is the 103, buying the 94. Notice there is a little debit. It's 20 cents or $20, but not much of a difference. Okay. Now, what I'm going to do is, I'm out of my time here. We got Brett Crowther coming up next with short verticals. Now, how do you really learn? You go out and practice. You got to paper trade 3 to 5 trades a week to get used to the market, get used to using the platform, get used to using the strategies. So do not shy away from practicing. Do not be afraid of screwing up. Be afraid of practicing too little. Okay? Screwing up, that's not really bad if you learn from it. Okay? And that's very important. That's why we have the Paper Money Count. Now, I want to wish you a great Good Friday tomorrow and a great weekend with you and your family. Stay tuned for Brett Crowther coming up next. Remember with what we discussed here today, it was done for example, illustrative purposes only. And this has been the class on trading the trend using stocks and options. With that said, again, have a great weekend and Friday. Thanks so much. Thanks to Connie as well. And thanks again to all of you. Take care. Bye-bye.